Hi everyone. Well, a lot has been going on in markets. Aggressive Fed talks, which is scaring investors, runaway commodity prices, war in Europe, dollar strength, CNY slump, COVID reopening in some parts, and closing in other parts of the world, and of course, mild signs of deglobalization. All of this has resulted in wobbly investor sentiments globally. The surge in commodity prices, which is now being led by agriculture and re-emergence of supply bottlenecks, have sort of increased the pre-existing inflation pressures on the world and have been posing challenges to the central banks across with regard to the growth trade-off that they may have to face. In this light, I think Fed is already on its way on doing something which it hasn't done in almost 30 years, which is 50 bips hike every consecutive meeting with even an outside channel 75 bips, essentially implying that they would become restrictive within a year, implying that they will start impinging on growth by going beyond the neutral policy rate. This will also come in conjunction with the fact that they will also be shrinking the balance sheet twice as quickly as they did in 2018. Um, while the Fed fights frantically to preserve its inflation credibility, if you see the cross asset behavior, that has been quite divergent. US 10-year has touched 3%, and every major asset class, barring commodities, cash, and trade-weighted USD, have delivered negative returns. This is a cross asset profile that is fairly consistent with what you saw in the 1970s Fed shock and 1994 Fed shock. And again, raises a very pertinent question as if, to which whether markets are fully pricing in the Fed actions ahead, and in a possible case of a very tight and restrictive policy and a recessionary state in the coming years. This also sort of prods us to think if Fed expectations are fully baked in the 10-year yield that is reflective at this point in time. And what happens if the 10-year yield actually peaks at this level, and how it would impact the asset classes across, in the markets. To some extent, I think we are inclined to believe that while UST 10-year may have some uptick in sight, there's a very fair case for us to build that we are probably near neutral or mildly bullish in bonds in coming months. With which, if you see the US money market curve, which is, if I'm seeing, if the spread between two-year and Fed funds rate, it's quite steep compared to the historical standards in the past highs, implying that to some extent, it has discounted significant tightening to a level that can be considered restrictive. And secondly, assuming that 3% marks the end of, or 3.5% marks the end of the terminal rates on Fed funds rate, whereas as in a point where Fed will stop hiking, one may again argue for a possible ceiling on the 10-year yield, at the same level. I mean, if you look at the past cycles, since the late 80s, what we conclude is that most of the cycles saw 10-year yield level at around terminal Fed funds rate. This strengthens our beliefs that UST 10-year may peak pretty soon, with some upside you may add because of the QEs, which were not happening in the past cycles, but will take place this time around in terms of the tightening of the QE that they saw in the past cycle, in the last 2 years. So clearly, the shrinkage of balance sheet again adds some premium to the yield at this point. But that said, even if we assume that the USD 10-year may peak at 3 or 3.5%, I think it's quite difficult to argue for a case of a renewal of the bull run that we saw in equities and credit market, because a large part of equity market was getting a little uneasy with the kind of uptick you saw in the bond yields. At best, it would impart some stability in equities and probably mild tightening in the credit spreads. And maybe in the near term, at least in the first half of this year, I think markets may still sail through because of an above trend growth narrative, barring the likes of Russia and China. And also, we are still seeing upside surprises in the US earnings, even domestic earnings for that matter. Maybe in the coming quarters or so, we'll start seeing multiple compression due to higher rates. But I think the large part of first half of this year would we essentially be a noise with regard to the dominant, with regard to the interest rate being the dominant growth theme driver. But I think the noises with regard to recession and reassessment of rotation will probably take place in latter half of the year, or maybe early next year, where weaker growth in earnings will probably be the bigger theme than the so-called interest rate hikes. So again, getting back to the equities point, if you see historically also, what we've seen is that whenever the 10-year peaks, equities and credit market tends to struggle. If you look at the 2001 and 6-8 cycle, And to some extent, 2018-20 cycle, we see the 10-year peaked about a year before the recession started. And interestingly, all these years were a confluence of high valuation, asset bubble, along with Fed tightening. In fact, the 2001 cycle had actually seen 10-year peaking just before the Fed stopped hiking rates. And essentially, what we saw in these cycles is that the equity and credit market delivered occasional bear market rally, but eventually they succumbed to the recessionary state. While it is anybody's guess, if the U.S. will see recession in the next 1.5 years or more, but absent any kind of miraculous supply side response globally, it is tough to see how a peak in 10-year yield this year between 3.5% leads to a start of the soft landing, which we saw in 95 in the US, and a bull run for the risk markets. Our sense is that most likely peak rates are just the prelude to the end of the short but the explosive business cycle that we saw in the last 2 years or so. But let's see how things pan out. Thank you.